Hello everyone, today is the 30th of July 2025 and how long will the BOJ be able to avoid the collapse of a major financial institution is today's Just Dario Daily. It's summer and many traders are already enjoying their holidays and stock portfolio gains, which are growing every passing day, regardless of the circumstances. No matter that, the underlying economies are falling more and more into a dark hole, a larger number of people are struggling to make ends meet, and the uncertainties about the future remain elevated, especially due to the big global trade mess that began on Liberation Day. It feels like ages, but just 1 year ago, we were about to experience exactly during this period one of the biggest financial market turmoils of the recent past. With regard to some metrics, even worse than what happened in 2020 or in 2008. On Monday, the 5th of August 2024, the Japanese stock market came very close to a total implosion, and that would have dragged down with it many other major financial markets, especially the US one, as a result of the first unwinding of hundreds of billions of US dollars in leverage linked to the JPY carry trade. I was one of the few people warning non-stop about the risk of the JPY carry trade and all the brutal consequences for the global financial system, way before the events unfolded, till the days just before the chaos reached its apex. I suggest reading the articles I wrote at that time, since the information there will be important to understand today's article. 2nd of August 2024, a traveler guide to navigate the Bank of Japan mess. 4th of August 2024. In Japan, it will be a messy Monday, but not a black one yet. Alright, then what the hell is going on today when everything is awesome and there should be nothing to worry about, according to the non-stop bullish narrative being fed to the public? Because interest rates are not buying the everything is awesome narrative, and instead of broadly coming down as many politicians wish, particularly the long duration ones, losses are mounting in the belly of banks, shadow banks, insurances, and pension funds. The situation, already bad, is becoming seriously dangerous in Japan due to the specific composition of many institutions' portfolios in the country. Predominant holdings of long and ultra-long duration illiquid fixed income assets, both in local and foreign currency. Just a few months ago, this headline briefly made global investors slightly uncomfortable. Japan's biggest life insurers post $60 billion in unrealized bond losses. In the article, the perfect storm is now starting to hit Japan's financial system. I posted a few days later, I warned once again, like a broken record, how interest rates would have continued to remain elevated and heading higher, digging a deeper and deeper hole into the balance sheets of Japanese financial institutions. In the following months, the BOJ successfully managed to contain and cool down JGB yields, especially the ultra-long 30-year and 40-year, thanks to constant and timely market interventions, along with relentless money printing through JGB's open market purchases that only briefly slowed down. Despite promises of hiking rates and trimming the ballooning of its balance sheet, a few weeks after the whole world acknowledged the hole in Japan's insurance system, the BOJ surprised markets and announced that due to new risks, it would delay its bond tapering plans to 2026. What risks was the BOJ blaming? Increasing economic uncertainty due to the US trade policy developments. Come on, man, what a joke. An even funnier joke is Wall Street analysts' expectations for the BOJ to resume rate hikes in the near future. In the same way, all these clowns failed to foresee the risks of a BOJ increasing rates after years at zero that later on unfolded with the near implosion of the JPY carry trade last year on the 5th of August. They are failing to foresee that the BOJ didn't fix the structural problems of the Japanese financial system, but only successfully managed to delay them into the future in what later on has been confirmed as an orchestrated bailout coordinated between them and Japan's GPIF. Inebriated by the global euphoria for rising stock markets, virtually nobody in the mainstream media, Wall Street or social media noticed how the frequency of BOJ market interventions continues to increase. Before, these were needed a handful of times a month. Then they became weekly, then multiple days a week, and lately multiple times a day. There are three types of extraordinary interventions the BOJ uses. Interventions that are meant to be a one-off, but clearly not anymore. Liquidity enhancement auctions are meant to provide targeted liquidity to primary dealers, ensuring market depth without distorting long-term yields. US dollar funds supplying operation and JGB's lending operations. For example, yesterday, like every Tuesday now, the BOJ performed a one-week US dollar funds supplying operation that is now regularly needed to avoid significant T-bills liquidations, with major impacts on the stability of money markets from Japanese financial institutions in badly need of US dollar liquidity. Liquidations that still occur regularly, as I punctually flagged every week on X. However, this time, this was followed by a JGB lending operation in the morning, and then by one in the afternoon on the same day. So, the BOJ performed a total of 3 interventions in a single day, and now the number of interventions required to stabilize markets is already 5 to 6 a week, usually on a Tuesday, a Thursday, and on a Friday before markets close. Yesterday's intervention stood out particularly because while government bond yields on a quiet summer day were mostly flat or heading lower, a sudden spike in 30-year JGB yields was enough to require the BOJ's prompt intervention. JGB lending operation followed right after the morning and the afternoon's sudden moves. Even if a few basis points upward move might seem negligible nowadays, I would like to remind you how this impacts a portfolio overexposed to long-duration assets and how such an urge to sell bonds in an illiquid summer market is likely caused by a financial institution under stress. What kind of stress? Considering that the BOJ quickly took action and started to lend JGBs in the market, it is likely that the financial institution is facing margin calls. Believe me, if margin calls are being delivered to a financial institution when there is no particular volatility in the market, it always means that the financial institution's counterparts are feeling more and more uncomfortable with its credit resilience and are demanding more collateral not to close their positions. When margin calls for significant amounts are being sent, the first thing a dealer does is to hedge its liquidation risk in the market. And in this case, it is likely that this JGB yields abnormal move was caused by short position open on JGB 30-year bonds. Thanks to JGB's intervention, collateral was delivered on time, and any open market liquidation was avoided. But considering that yields did not come down thereafter is a sign that the counterpart dealer kept the hedging in place to match the risk on a larger collateral position. Needless to say that a financial institution in such a poor shape as not to have collateral left to meet margin calls and not in the condition to liquidate assets to scale down its risk exposure, likely because that will result in the crystallization of significant losses both on the asset sale and the wind down of the position against the counterpart that sent the margin call, the situation of the financial institution is pretty critical. At this point, it is fair to wrap things up, providing some guidance on which institution, hopefully only one, can be the one struggling to stay afloat. We already know that Norinchukin Bank, the second largest lender in Japan, has been fighting against insolvency for quite a long time now. And this bank is so important to the global financial system that it has been granted access to the Fed's standing repo facility, as I flagged right away in 2023. And, of course, a major development broadly ignored by mainstream media and Wall Street. We also know that SoftBank is running out of cash. Back in May, in the latest update on this institution, I wrote, SoftBank goes all in on AI with the little money it has left. And clearly, the situation in the past months has been worsening, considering SoftBank is now public news that it is struggling to source the funding for the nonsensical Stargate project. Among Japanese insurances, the total 8.5 trillion JPY amount of unrealized bond losses against 200 trillion JPY of assets, most of which are in illiquid, long and ultra-long duration fixed income securities, is obviously very understated. However, due to the lack of transparency, it is hard to make a more accurate estimate. Just to give an idea, if an investor bought 30-year JGB bonds in 2022 and held them till today, the theoretical loss in face value of that investment will be roughly 35%. In the case of 10-year JGBs, using the same assumption, the unrealized loss today will be 11%. These institutions are also notoriously invested in long-duration foreign assets, mostly in US dollar, like US Treasuries, mortgage-backed securities, and commercial mortgage-backed securities, assets that currently are trading at a significantly lower price compared to the ones they held for a long time during the zero interest rate policy years. Here is the list of the major Japanese insurance companies ranked by assets to capital ratio. The higher the ratio, the more solid in theory the insurance balance sheet. Feel free to make your own conclusions. Nippon Life 9.5, Meiji Yasuda 10.5, Sumitomo Life 10.6, Dai-ichi Life 12.7. Thanks a lot for listening again to my podcast today, for liking the video and subscribing to the channel. I would like to remind everyone about the summer promotion we're having at Synax, where you can have 1 month free of access to the stock intelligence provided in the platform without any string attached. And thanks a lot for supporting me on X and for reading and commenting my articles on justdario.com. I wish everyone a nice day.